Now, when we wonder about how Indonesia is doing so well, just keep in mind, Indonesia is one of the few countries that can actually have an expansionary fiscal policy, and that's what happened in 2012. It wasn't a big stimulus, maybe it came in the wrong way, through fuel prices weren't increased, but still, having an expansionary fiscal policy when everybody else has to have a contractionary one is a huge advantage. The second issue is monetary policy. Monetary policy around the world, as you know, is extremely loose. It's loose in the it's loose in the advanced economy, almost everywhere. It's very close, interest rates are very close to zero, central banks are buying assets, but on the other hand, there is still not a lot of lending. This very loose monetary policy is supporting financial assets, it's supporting perhaps commodity prices because investors can finance their purchases at very cheap rates, but it's not really supporting the economy. It is not supporting the economy in the sense that SMEs still can't get a lot of credit in many of the advanced countries. Credit, as you will see, I think one of the charts here show, is very, very weak in the advanced economies and even in quite a few emerging market ones. So monetary policy, even with interest rates close to zero, is not offsetting enough this contractionary fiscal policy. Now, in view of this, how do we see the situation in 2013? I think, and Dr. Hatip Bashri hinted at this, it's going to be a weak recovery, and the weakness could last for quite a while. I have provided a table with some projections. I'm still using IMF projections. The world is only projected to grow at 3.6%. US 2.1%, Eurozone close to stagnation, Japan close to 1%. China is close to 8%. In other words, a soft landing is assumed. Still, despite these modest growth rates, we have rather strong risks. The key risk, of course, is Europe. Now, yesterday, there was a very good agreement on Greece, which reduces interest rates, which extends maturities, with some of the profits of the central bank, ECB, for purchasing Greek debt, are being given back to Greece. This is all very, very good, but still, Europe remains in a situation where a lot of firefighting will be required over the coming period. Greece will probably still need further assistance, despite the fact of this help a few days ago, because its debt is just so huge. Its debt is just huge that further, probably, round of negotiations will be needed. Spain may also need to get the support of the ECB and the European Union. The second big risk is the fiscal cliff. If Congress and the President don't come to an agreement, it will be a massive withdrawal of money from the economy, very contractionary, 4% of GDP. These projections assume that this issue is resolved. If they're not, the US will certainly go into recession. Oil prices, you see still a lot of problems in the Middle East, even though probably at least the United States is less dependent on Middle East oil, there is still huge potential for a hike in oil prices, which could undermine this weak recovery. Also, a more long-term problem is that because unemployment has been high for so long, people are losing their skills, and potential growth over a long period in the mature economies is going to be much lower. These factors, of course, would affect Indonesia. In the note, we have written in what way. Now, let me move on to Indonesia. It's a remarkable contrast to the rest of the world. I was amazed by two recent numbers. First, in the third quarter, private consumption grew 5.7% year on year. This is the highest number since the recovery from the 2009 crisis, it's the highest in the last 2 or 3 years. Also, in November, the consumer confidence numbers came out, and the Bank of Indonesia showed that consumer confidence had reached historically the highest level ever. Can you imagine, with all that's happening in the rest of the world, Indonesian consumer confidence is at the highest level ever. Now, these are remarkable numbers, and there is, I don't think there is any reason it should not continue. Even with the central bank putting the brake on motorcycle purchases, you see, and motorcycle purchases have to come down. The rest of consumer purchases are very strong. Investment also is slightly moderated in the third quarter. It was 12% growth in the second, 10% in the third quarter, but this is still very strong. And I think the pipeline is such that that there will continue to be very strong investment. Now, all of you have mentioned some problems here with the investment climate. Dr. Hatip mentioned 50% divestment requirement in mining. There has been the gas issue. I think, you see, the fact is that these measures will not affect investment immediately. So, given the pipeline that we have now, we can have strong investment growth for the next several quarters, or perhaps even years, despite these measures. But I think that does not reduce the potential damage they could do to growth over the next, let's say, over a 5-year horizon. These measures cannot have a short-term impact. Now, so it's really a balancing act, I think, between some of the potential that Dr. Hatip Basri described here and the momentum it has now, and the increased uncertainties for the future. Now, given all this and the fact that the global economy is slowing, I think Indonesia in 2012 will grow at 6.3, more or less as expected. But there is probably, unless the global economy takes off, Indonesia will probably not be able to reach these 7% plus growth rates that are targeted. You see, it's true, as Dr. Hatip Basri said, the fact that things are bad in the rest of the world in some ways drives investment to Indonesia. But on the other hand, the fact that demand is very weak, that external demand is very weak, that commodity prices have dropped, is also a very important channel. And that's why growth is moderated from about 6.5% to 6.2, 6.3% in the most recent quarters. So it's actually quite surprising that this global slowdown is not having more of an impact on Indonesia. I would attribute that, of course, it's a strong domestic demand, but it's also the fact that this is a very large country and it's a diversified economy. Plantations and coal, still exports of palm oil and coal, still only represent 6% of GDP. So the multiplier effects when salaries, employment, investment goes down in coal mines and in plantation is still limited. Of course, it adds up if you put other commodities there, but still, Indonesia is less dependent on commodities than people usually think. Inflation at the moment, the news is all good. The inflation is right in the middle of the PI target range at 4.5%, but there are some risks. Traditionally, in inflationary expectations in Indonesia have been driven by increases in either food prices or fuel prices, or energy prices as well. I mean, electricity is a factor too. Given the politics, maybe it would be difficult to go ahead with energy prices, but I think there is some tail risk probably from food, especially given that I understand some restrictions have been introduced with the food law, and if that makes importing more difficult, that could put some upward pressure on prices and inflation. The large increases in the minimum wage, of course, they don't affect the entire workforce, and we're really in uncharted territory here. Traditionally, it's not, increases in minimum wages has not been what has driven inflationary expectations, but some of these increases are so large that we could see a change to that pattern. Now, one of the main concerns that financial investors have had recently has been the increase in the current account deficit. It reached a very big amount in the second quarter, 7.7 billion, I think, well over 3% of GDP. It's narrowed in the third quarter, yeah, as expected. But I think it will widen again in the fourth quarter, given that seasonally there are a lot of payments of dividends, investment income in the fourth quarter. And it should stay at about 2% of GDP or over that in 2013. I mean, Indonesia, as Dr. Hati mentioned, needs a current account deficit. It needs foreign savings to finance investment and drive growth up. So I think it's perfectly natural for the country to have a current account deficit. However, this is a very uncertain climate in terms of financing. So the effort, I think, from the part of BI should be to be quite careful and to try to keep the current account deficit to the amount that can be financed through FDI. Now, you saw Dr. Hati Basri mention FDI this year is expected at 32 billion, but that is a gross number, right? That adjusts the inflows. What you have in Indonesia is a lot of Indonesian companies invest offshore. So the net number is maybe a little bit over 20 billion in terms of inflow. On top of that, there have been some domestic capital outflows through the other capital. So really, given that portfolio capital, that is foreign purchases of bonds and shares, can reverse at any time, the BI should really try to keep the deficit, the current account deficit, to not more than 2% of GDP. Actually, I think BI should be commended as the increase in the past year through concerns in the current account deficit. So it's good to know that somebody is keeping an eye on the current account deficit. I interpret the current BI monetary policy stance as a little bit of a bias towards possible future tightening because of the current account deficit. Now, fiscal policy for 2013 will actually be contractionary. That means the government will withdraw money from the economy if the budget is realized. I don't really see a need for that because the financing is relatively easily available. There is no debt problem. And in 2013, the government is actually targeting much lower growth of capital expenditures, i.e. spending on the infrastructure, than previously. I.e. already it is being squeezed out by the fuel subsidies. So in the past, we have said that fuel subsidies are inefficient, that they don't help the poorer segments of the population. But it's not really a direct fiscal problem because capital spending from the budget was more held back by the fact that there were implementation problems than by the availability of resources. But in the last 2 years, spending from the budget on infrastructure, capital spending, has actually gone up quite a lot. It's probably not enough, given the infrastructure shortfalls and bottlenecks, but it did go up 50% in 2011 and is going up 35% this year. These are quite sharp increases. However, the government is targeting only a 15% increase in capital spending next year. This is because it just doesn't have the money. It's being squeezed out by fuel subsidy. So there are two options. Either have a slightly bigger deficit, which I think is acceptable given where Indonesia is with its debt, Or the second option is to increase fuel prices. And of course, that's the one most economists favor, but very difficult politically. So I think I'll end there. Prospects for the short term for Indonesia are basically sound, but then there's just too many announcements recently, I think, that raise uncertainties for the longer time horizon. Thank you very much.
Thank you very much. We'll keep this kind of format for the next year. And of course, unless you have questions, and then we will finish this breakfast meeting. But of course, as I mentioned to you before, next year we will start probably in February, if not January, because January usually after the long vacation, so it is better to start on February in 2013. Thank you very much. Unless you have any question for Milan, and if not, then we will finish this breakfast meeting. And if you have any questions, we can still stay here for another minute or several minutes, so we're ready to answer your question. Thank you very much, Milan, and thank you very much, everybody, and good morning.
Thank you.